Indian tax base has grown, but it still has a long way to go. According to income tax website, the total number of taxpayers are around 45 million till December 2021. Accordingly, to increase the tax base and increase compliance, the budget 2022-23 has brought in numerous changes. Few of such major changes are: a concept of updated return is proposed in the budget. The updated return will allow the taxpayer to correct any omissions or rectify the mistakes. It can be filed up to 24 months from the end of the assessment year. An additional tax will be required to be paid for filing of updated return. The updated return can only be filed subject to certain conditions. Budget also clarifies that any amount paid as cess or surcharge are not allowable expenditure. This amendment is retrospective from the assessment year 2005-2006. Another change is relating to the intent of introduction of Section 115 BAB, which was to attract investment, create jobs, and trigger overall economic growth. However, the cumulative impact of the persistence of COVID-19 pandemic has resulted in some delay in setting up or registration of new domestic companies and the commencement of manufacturing or production by such companies. In order to provide relief to such companies, it is proposed to amend Section 115 BAB so as to extend the date of commencement of manufacturing or production of an article or thing from 31st March 2023 to 31st March 2024. Another change has been brought in for startups. As we all know, startups have emerged as driver of growth for our economy. Over the past few years, the country has seen a manifold increase in successful startups. Eligible startups, which are established before 31st March 2022, had been provided a tax incentive for 3 consecutive years out of 10 years from incorporation. Now it is proposed to amend the provision of Section 80 IAC of the Income Tax Act to extend the period of incorporation of eligible startups to 31st March 2023. Virtual digital assets have gained tremendous popularity in recent times, and the volumes of trading in such digital assets has increased substantially. Further, a market is emerging where payment for the transfer of such virtual digital asset can be made through another such asset. Therefore, Section 115 BBH has been proposed, which provides that where the total income of a taxpayer includes any income from transfer of any virtual digital asset, the income tax payable shall be the aggregate of the amount of income tax calculated on income of transfer of any virtual digital asset at the rate of 30%. However, no deduction in respect of any expenditure other than the cost of acquisition or any allowance or any set-off of any loss shall be allowed to the taxpayer under any provision of the Income Tax Act while computing income from transfer of such virtual digital asset. This typically taxes the virtual digital assets such as the Bitcoin or Dogecoin or any other virtual digital assets based on blockchain technology. India is highly dependent on its indirect tax laws for its fiscal collections. Accordingly, in 2017, GST regulations were introduced as a main source of finance to the Government of India. GST is an evolving law and there are always scope for changes. Accordingly, certain changes have been brought in GST laws in this budget. The first major change is, in order to ensure seamless flow of input tax credit and to mitigate misuse of availment of input tax credit, a clause has been inserted in GST regulations to enable condition for availing input tax credit only if such input tax credit appears in GSTR 2D of the taxpayer. GSTR 2B is based on corresponding outward supplies reporting filed by the supplier of the taxpayer. The second major change is, earlier the taxpayer could have availed input tax credit against the invoice for a financial year only up to the date of filing the return of September following the end of financial year to which such invoice pertains. This period now has been extended to 30th November. Similar changes have been made for amendment in GSTR 1 and issuing credit notes and their subsequent reporting. Another change is for ensuring compliances. A stricter clause has been inserted to provide that proper officer can cancel the registration of person, that is the registered person, if there is a default of filing returns for certain period. Also, a condition has been put to restrict the taxpayer for filing GSTR 1, which is a return for outward supplies, if the GSTR 1 or previous tax periods have not been filed. Also, an amendment has been made to restrict the taxpayer for filing GSTR 3B if the GSTR 1 for the said tax period has not been filed. A change in compliance for a non-resident taxpayer has been introduced, where the non-resident taxpayer earlier was required to furnish return electronically within 20 days of the end of the calendar month, but by this amendment, such time period has been reduced to 13 days now. A change related to ease of doing business has also been introduced. Earlier, the taxpayer was allowed to transfer the balance amount in its electronic cash ledger to any other head of cash ledger. Now, after this amendment, a taxpayer can now make a transfer of balance of its cash ledger to any head of cash ledger of its distinct person. Distinct persons are people having the same PAN number but different registrations. Typically, the branches of companies or branches of partnership firms situated in different states of India. But there is a condition: no such transfer is allowed if any liability is unpaid in its electronic liability ledger.